Hi, everyone. Welcome to the webinar. I appreciate you taking the time. Let's give everyone a minute to get on. If you're on the call, please type yes so I know you're all here. Okay? Good. I see it. Well, grab a coffee or tea or a drink and a notepad, and let's get started. Are you confident you're making the right decisions to reach the retirement you want? Are you tired of not having a personal relationship with your financial advisor? Are you tired of having to dial a 1-800 number and not knowing who are you going to talk to about your retirement funds? If that's the case, you are in the right place. Hi, I'm Peter J. O'Brien, Investment Advisor Representative with Voya Financial Advisors. You can call me Pete. I'm not a 1-800 number. I'm a real-life person. What's important to me is family. Here's a picture of my granddaughter. Her name is Liv, and the picture describes who she is. I want to know what's important to you and how having extra money can assist you with that. Yes, money is important to all of us, but when it comes to retirement, when it comes to your hard-earned savings, what is important to you? That's what I want to talk about, and hopefully soon. What I want to learn more about if you and I have the pleasure to meet. Who is this for? If you have a 401k, an IRA, a 403b, or any other retirement account, and are between the ages of 50 and 70, or you're in between jobs, what we're going to talk about here you don't want to miss. So let me ask you this. What would your life look like if you could have a retirement of your dreams? What if you can make an educated, well-coached decision with your retirement funds to be confident that you will reach your retirement goals? In the next 20 minutes, I'm going to talk about why you should have an investment policy with your retirement assets. Investment policy statement is a document that gives you a guideline based on questions that you've answered in regards to how your money is to be managed. Learn about asset classes and why it's important to diversify across them. Educate yourself so that you can make better financial decisions which lead to a better and happy retirement. I'm going to share some vital statistics you should know about that have to do with making the right choices for your financial future. What makes this different? Nothing is for sale. Just good, helpful content about your retirement funds that may give you confidence. So why stick around? I want to bring up the topic of Social Security and share this report with you as a bonus for watching the webinar. How do you feel about Social Security? Let me ask you a question. Do you feel like you don't have enough time or knowledge to invest in a comprehensive planning process that will give you the retirement you want? Is your financial plan reviewed at least once a year to ensure you're on track? Are you worried you'll not have enough funds to retire on and will not be able to get the retirement that you want? Are you overwhelmed by not knowing what is really going on with your retirement funds? Or you just don't know what changes to make to ensure you're on track? Do you want a financial professional that you can shake hands with who's not a 1-800 number? Or do you just feel stuck because you don't know where to go and who to turn to? Or maybe you just feel you're missing something and you might not achieve your retirement goal. Hey, listen, here's some awesome news for you. If any of this feels like you, don't fret. You just haven't made the 5 essential shifts I'm going to show you here today. Making those shifts could lead to a clearer idea of where you're going and how you're going to get there. I'm going to show you strategies to help make the right investment choices for your ideal retirement. Listen, having more confidence about your retirement will help you maximize your time on things that matter to you, like your family, your hobby, your leisure time, your work, whatever you want to do. And lower stress level can lead to a better life. What you need to know. These are 5 simple upgrades to consider making to help achieve the retirement you want. Again, hi, I'm Peter O'Brien. I'm an investment advisor representative with Voya Financial Advisors. I've worked with people's retirement funds for the last 30 years. I've accumulated a wealth of knowledge and experience to help my clients navigate their financial future. Through the many financial tools that I make available to my clients, I'm able to guide them and coach them through their retirement years and help them reach their retirement goals. I also want to add, my wife Diane and I have 7 wonderful children from ages 18 to 28. I played hockey and soccer in college, and I've coached youth select hockey teams with many former players receiving college scholarships and playing in the professional ranks, and I'm really proud of that. I want to show you my family. This was at my oldest son's wedding recently, and my cute little granddaughter Liv. Isn't she great? She's such a happy kid. Now let's show you what these 5 shifts are. The first one is have a financial plan, and that will help you see the big picture. Here's what I mean. What are some of the goals you have? Do you picture yourself owning a home, starting a business, or retiring comfortably? These are a few of the financial goals that may be important to you, and each comes with a price tag attached. That's where financial planning comes in. Financial planning is a process that can help you target your goals by evaluating your whole financial picture, then outlining strategies that are tailored to your individual needs and available resources. Having a clear picture of your current financial situation by reviewing your income, assets, and liabilities, and evaluating your insurance coverage, your investment portfolio, your tax exposure, and your estate plan can help you formulate a personalized financial plan that serves as a framework for organizing the pieces of your financial future. With a financial plan in place, you'll be better able to focus on your goals and understand what it takes to reach them. One of the main benefits of having a comprehensive planning process is that it can help you balance competing financial priorities. A financial plan will clearly show you how your financial goals are related. For example, how saving for your children's college education might impact your ability to save for retirement. Then you can use the information you've gleaned to decide how to prioritize your goals, implement specific strategies, and choose suitable products or services. Best of all, you'll know that your financial life is headed in the right direction. When it comes to planning for your retirement income, it's easy to overlook some of the common factors that can affect how much you'll have available to spend. If you don't consider how your retirement income can be impacted by investment risk, inflation risk, catastrophic illness or long-term care, and taxes, you may not be able to enjoy the retirement you envision.
For example, when it comes to your 401k contribution, did you know that if you're over 50, with the catch-up, your total annual contribution amount can be $25,000. And with the IRAs, that contribution can be $7,000 per year.
Now, don't forget to include your investment policy statement into this financial plan. Investment policy statement is a guide to your financial future. It's a map, activity schedule, and outcome document between your financial advisor and you, and it should include details like asset allocation, risk tolerance, and your financial goals. Not having a written investment policy statement can often lead to chasing short-term performance that may hinder reaching long-term goals. This is especially important during turbulent times. Okay, here's the second shift. The combination of investments you choose can be as important as your specific investments. The mix of various asset classes, such as stocks, bonds, and cash alternatives, account for most of the ups and downs of a portfolio's return. Deciding how much of each you should include is one of your most important tasks as an investor. That balance between potential for growth, income, and stability is called your asset allocation. It doesn't guarantee a profit or insure against a loss, but it does help you manage the level and type of risks you face. Ideally, you should strive for an overall combination of investments that can help to minimize the risk you take in trying to achieve a targeted rate of return. This often means balancing more conservative investments against others that are designed to provide a higher rate of return. But that also involves more risk. For example, let's say you want to get 7.5% return on your money. Your financial professional tells you that in the past, stock market returns have averaged about 10% annually, and bonds roughly 5%. One way to achieve your 7.5% return would be by choosing a 50-50 mix of stocks and bonds. It might not work out that way, of course. This is only a hypothetical illustration and not a real portfolio, and there's no guarantee that either stocks or bonds will perform as they have in the past. But asset allocation gives you a place to start. Your asset allocation is, or should be, as unique as you are. Even if two people are the same age and have similar incomes, they may have very different needs and goals. You should make sure your asset allocation is tailored to your individual circumstances. Even within an asset class, consider how your assets are allocated. For example, if you're investing in stocks, you could allocate a certain amount to large cap stocks and a different percentage to stocks of smaller companies, or allocate based on geography. Bond investments might be allocated by various maturities, with some money in bonds that mature quickly and some in longer-term bonds. Or you might favor tax-free bonds over taxable ones, depending on your tax status and the type of account in which the bonds are being held. Even if you've chosen an asset allocation, market forces may quickly begin to tweak it. For example, if stock prices do go up, you may eventually find yourself with a greater percentage of stocks in your portfolio than you want. If they go down, you might worry that you won't be able to reach your financial goals. The same is true for bonds and other investments. Do you have a strategy for dealing with those changes? Of course, you'll probably want to take a look at your individual investments, but you also want to think about your asset allocation. Just like your initial investing strategy, your game plan for fine-tuning your portfolio periodically should reflect your investing personality. Even if you're happy with your asset allocation, remember that your circumstances will change over time. Those changes may affect how well your investments match your goals. At a minimum, you should periodically review the reasons for your initial choices to make sure they're still valid. Also, some investments, such as mutual funds, may actually change over time, so make sure they're still a good fit for you. Keeping your cool can be hard to do when the market goes on one of its periodic roller coaster rides. It's useful to have strategies in place to prepare you both financially and psychologically to handle market volatility. Here are some ways to help keep yourself from making hasty decisions that could have a long-term impact on your ability to achieve your financial goals. Not having a game plan is the biggest mistake people make and the primary reason they fail. Having predetermined guidelines that recognize the potential for turbulent times can help prevent emotion from dictating your decisions. For example, you might take a core and satellite approach, combining the use of buy and hold principles for the bulk of your portfolio with tactical investing based on a shorter-term market outlook. You also can use diversification to try to offset the risks of certain holdings with those of others. Diversification may not ensure a profit or guarantee against a loss, but it can help you understand and balance your risk in advance. And if you're an active investor, a trading discipline can help you stick to a long-term strategy. For example, you might determine in advance that you'll take profits when a security or index rises by a certain percentage and buy when it's fallen by a set percentage. Financial markets are historically cyclical, and not knowing why you own a particular security and wishing you had sold it at market peak or regretting having sat out a buying opportunity of a security are decisions that many securities owners face daily. When the market goes off the tracks, knowing why you originally made a specific investment can help you evaluate whether your reasons still hold, regardless of what the overall market is doing. Understanding how a specific holding fits in your portfolio also can help you consider whether a lower price might actually represent a buying opportunity. And if you don't understand why a security is in your portfolio, find out. That knowledge can be particularly important when the market goes south, especially if you're considering replacing your current holding with another investment. Use cash to help manage your mindset. Cash can be the financial equivalent of taking deep breaths to relax. It can enhance your ability to make thoughtful decisions instead of impulsive ones. If you've established an appropriate asset allocation, you should have resources on hand to prevent having to sell when the market is down. Having cash cushion coupled with a disciplined investment strategy can change your perspective on market volatility. Knowing that you're positioned to take advantage of a downturn by picking up bargains may increase your ability to be patient. Remember your roadmap. Solid asset allocation is the basis of sound investing. One of the reasons a diversified portfolio is so important is that strong performance of some investments may help offset poor performance by others. Even with an appropriate asset allocation, some parts of a portfolio may struggle at any given time. Look in the rearview mirror. If you're investing long term, sometimes it helps to take a look back and see how far you've come. If your portfolio is down this year, it can be easy to forget any progress you may have already made over the years. Though past performance is no guarantee of future returns, of course, the stock market's long-term direction has historically been up. With stocks, it's important to remember that having an investing strategy is only half the battle. The other half is being able to stick to it. Even if you're able to avoid losses by being out of the market, will you know when to get back in the market? If patience has helped you build a nest egg, it just might be useful now as well. Deciding when to retire may not be one decision, but a series of decisions and calculations. For example, you need to estimate not only your anticipated expenses, but also what sources of retirement income you'll have and how long you'll need retirement savings to last. You'll need to take into account your life expectancy and health, as well as when you want to start receiving Social Security or pension benefits, and when you'll start to tap your retirement savings. Each of these factors may affect the others as part of an overall retirement income plan. Here are current life expectancies from 2016. You have to make sure that your money will last long enough in your retirement. For example, delay in retirement could have some impact on how much money you actually receive. So when it comes to your retirement, savings builds your foundation for being able to take advantage of the compound interest and get your money to work for you. Remember, inflation erodes your buying power. You have to try and stay ahead of inflation. As always, you've got to keep some liquidity in case we have adverse conditions. Making decisions about your retirement account can seem overwhelming, especially if you feel unsure about your knowledge of investments. However, the following basic guidelines can help you make smarter choices regardless of whether you have some investing experience or not. You've got to stay true to these basic investment guidelines. Number 1, don't lose ground to inflation. 2, invest based on your time horizon. 3, consider your risk tolerance. 4, integrate retirement with your other financial goals. And 5, don't put all your eggs in one basket. Imagine being confident about your retirement. Imagine being in control of your retirement and being educated to be able to make the right decisions. Imagine feeling confident you're on the right path to get the retirement you want. Remember, it's important to have a financial plan. It's important to diversify into an appropriate asset allocation for your risk tolerance and goals. It's important to stay sane in a crazy market. And remember the effect time has on your retirement. All this while following the basic retirement investment guidelines. This is how you get the confidence that you'll have the retirement you want. Today I promised to walk you through some of the basic financial planning tools, and hopefully you've enjoyed it. So now you have a choice to make. You can spend time and effort to educate yourself and do it by yourself, or you can choose a financial professional to help guide you with your retirement choices and be with you every step of the way. Here's how I can help you. I have a limited number of openings, and I've set aside some time in the next 2 weeks to speak to you personally about how you can apply these strategies to your retirement plan. The cost is free. Not only that, I will buy you lunch and meet with you for up to 1 hour at your favorite lunch spot. That could be Olive Garden, Granite City, Panera Bread, Applebee's, Perkins, really. Pick a place and let's meet. Now, on this appointment, we'll have a soup, salad, sandwich. You can enjoy a full menu at your favorite lunch spot. We'll get to know each other. We'll talk about the financial world, and most importantly, we'll talk about your retirement strategy. If we decide to work together, we'll create a retirement plan that fits your need and puts you in control of your retirement. And you'll have an experienced financial professional by your side to help along the way. Here's what you need to do. Number 1, reserve your lunch spot. Where do you want to eat? Number 2, bring your most recent retirement account statement or statements. And number 3, show up with an open mind to discuss your goals. As you can imagine, spaces are limited, so reserve your lunch spot now. You've got nothing to lose. You can type this link in your browser or click below to get started. I really look forward to the opportunity to meet you and help you. Sign up for lunch, and if you get to know me, you'll get to know this happy kid.